Aditya Birla Group presents Budget 2015, the Make in India Budget, co-presented by SBI. What the world wants.
Hello and welcome to our special show, What the World Wants from India. In this pre-budget series, we have been getting you a galaxy of top-notch India watchers to check out what foreign investors and experts are expecting from the budget, from the Indian economy, and of course from policymakers. Joining me today is Larry Hathway, the Chief Economist at UBS Investment Bank. Mr. Hathway, thank you very much for joining me. Well, let me begin by asking you about the mood regarding Indian markets. Indian equity markets got a decent amount of money last year, about $16 billion, not the best in terms of run rate, but decent. Do you think India has a chance of remaining a favored emerging market in 2015 as well?
I think so, that within the emerging complex, there are several things that make India relatively attractive. First of all, much of the emerging complex is suffering from the steep declines in commodity prices. And apart from food, India, of course, is primarily a user of commodities and therefore a general beneficiary of, for example, falling oil prices. Those benefits have also been, to some extent, taken advantage of by the new government with their attempts to reduce fuel subsidies, which will help, of course, the fiscal position of the country and is part of a broader reform agenda that investors are looking forward to eagerly. And that's another reason, broadly, reform, that is, why India stands out. There are very few emerging economies, indeed very few economies anywhere in the world that are pursuing reform agendas, even though those agendas are required in many places. India and Mexico stand out as two countries that are pursuing reform, not just talking, but actually taking active measures. And that is something that is, I think, gratifying to global investors. They do need to see more. They need to see further steps in liberalizing other parts of the Indian economy. But in general, I think those two factors, the non-commodity nature of the Indian economy and also its reform agenda, are going to be positives for it in the course of 2015.
Oh, that's good to hear. But do you think India can continue to bank on this benign commodity cycle for a better part of calendar 2015? It has been helpful in reining our fiscal deficit, but will this advantage last? And if so, for how long?
Well, it is difficult when it comes to commodity prices to make forecasts with a great degree of certainty. Oil prices do appear to have stabilized and are beginning to perhaps edge a little higher, so the bulk of the declines now looks to be behind us. Food prices are even more difficult, I think, to forecast, particularly in countries like India, where weather conditions, monsoon and so forth, can make a considerable difference in harvests and therefore prices. But when we look at factors globally, there are reasons to believe that commodity prices, lower commodity prices, are here to stay. One of those global factors is the value of the U.S. dollar. Typically, when the dollar is appreciating, commodity prices tend to fall or remain depressed. And that's something we should anticipate, given the strength of the U.S. economy and the Federal Reserve's intention later this year to normalize interest rates ahead of any other central bank in the world. So a strong dollar is probably going to be a key factor in keeping commodity price increases at bay, and again, that's going to be favorable for India.
Well, other commodities apart, crude is the one that bothers India the most, the biggest import item. What's the UBS, or what's your range for crude in 2015? Does it get back to triple figures?
Yeah, the range is a little bit higher for, say, Brent crude prices. We probably can edge back towards the end of this year towards maybe $75 a barrel. So that would be another $15 or so above current spot prices. That certainly is well below, of course, the levels that prevailed this time a year ago and all the way until the spring, summer of last year. So from that perspective, I think it is generally still a benign story for inflation, for the budgetary position of India, and for consumers in terms of purchasing power. So from that perspective, even though there may be some modest uplift particularly as production begins to settle back in North America and as well as in Russia, in light of the strains that lower oil prices are putting on marginal producers, it isn't something where we'd expect an immediate return to the status quo ante of triple-digit oil prices. I think that's going to take quite a bit longer. And as I mentioned a moment ago, the strength of the U.S. dollar is going to be one of the factors that restrains oil prices from returning back to the sort of north of $100 per barrel Brent prices that we had seen 12 months ago.
Okay. Mr. Hathway, will global investors be upset if the Indian government reneges on the fiscal deficit target? I mean, you know that we are all in a pre-budget mode, and this deficit number of 3.6% is what everyone is watching. Will that be very important for you as a foreign investor?
I think what the investors are looking for is further consolidation. The progress made to date, I think, has been impressive, and the measures which in previous governments might not have been possible, unpopular measures like removing subsidies, are a big step in the right direction, and falling crude oil prices obviously made that economically and perhaps also politically a more viable option. Further progress, though, I think would be welcome on two grounds. First of all, getting deficits down to manageable levels to stabilize indebtedness is generally seen as positive in the capital markets. Secondly, to the extent that fiscal consolidation continues, it can allow the Reserve Bank of India to begin to trim interest rates, given that essentially the war against inflation is being won, that is, inflation is declining, and with a tighter fiscal policy, it will give the RBI more room to trim interest rates, and that too would be welcomed by foreign investors, and I would say overall by share prices in India.
Well, actually, how much are you expecting in terms of rate cuts from the Reserve Bank? Governor Rajan is being seen in some quarters as almost Volckerian in his, interest in chasing down inflation with higher rates. If there aren't so many rate cuts, will the markets take it as negative?
Well, I think he certainly is perceived as an inflation hawk, as you described him, sort of India's version of Paul Volcker from some 35 or so years ago. It's an interesting comparison, and it certainly is, I think, valid in the sense of the commitment of the Reserve Bank now to try to bring inflation to more mid-single digit and maybe ultimately towards lower single-digit ranges consistent with the norms that have been achieved in many other countries around the world. I would say that the Reserve Bank actually surprised people with its interest rate cut. So to some extent it is maybe now out in front of the markets a bit, although that only, I suppose, whets investor appetites for further rate cuts to come. My sense is that it's going to be a gradual process from here. Clearly, hard-won victories are not to be easily given away. The Reserve Bank will certainly be vigilant around inflation. And as I mentioned a moment or two ago, there are some factors that drive Indian inflation which make it particularly difficult to predict, particularly I'm referencing here food prices, monsoon, harvest, and so forth. And from that point of view, I think the Reserve Bank will probably keep its options open. But in general, we should be seeing an easing bias in the course of 2015.
Oh, yes, that point is taken. Well, coming back to the budget, Mr. Hathway, what exactly are you looking for in the budget or maybe even in the government policies in general?
Well, I think the foreign investor initially is probably going to be looking just at consolidation and the general path. I think other than the budget itself, the primary focus will be more on liberalizing foreign investment into the country, liberalizing some of the structures of the economy to allow higher productivity growth. Most of the economists, at least that I observe and that I follow, who more closely follow the Indian economy, are really trying to look for measures to improve long-term trend growth of the economy, which is really about two things. It is about raising worker productivity, total factor productivity, and it's also about increasing the participation rate in the economy of the Indian labor force. Those things really go beyond, I suppose, strictly speaking, what the budget can achieve, and really speak much more to, say, structural measures to reform the economy.
Fair point there. Well, finally, let me end with the global ambience. What is your sense on rate increases from the Fed, or indeed the first rate increase? When are you expecting the first rate hike? And could that yet again create a flutter as far as, say, Indian currencies or equity markets are concerned?
Yes, well, first of all, I do think that investors worldwide, in the developed as well as the emerging markets, will be following the Fed's words and its actions closely in the course of this year. In terms of what we expect by way of rate hikes, we anticipate that the Federal Reserve will initiate the first of those rate hikes in June of this year. That's perhaps a little bit earlier than the market consensus believes. Perhaps where we differ more from our peer group and from the market expectations is that we expect the Federal Reserve then to follow through with rate hikes in the meetings to follow, bringing the Fed funds rate above 1% by the end of this year. In comparison, the market, in terms of futures prices, is actually looking for a much more gradual pace of normalization with only 2 rate hikes in the course of the second half of 2015. To the second part of your question, will that cause something akin to the taper tantrum of 18 months ago? Perhaps, but I think the chances are somewhat reduced by the actions of other central banks, particularly the ECB, but to some extent the Bank of Japan. It's fairly clear that low bond yields in Western Europe are helping to keep under control any rise in bond yields in the United States. And when we go back to that taper tantrum episode, it was the rise in 10-year yields that was abrupt, that caused such dislocations, particularly in emerging debt and emerging currency markets. If by virtue of the, let's say, the support that the ECB is giving globally to low interest rates, including treasuries, if that remains in place, which we suspect it will, then adjustments at the front end of the curve by the Federal Reserve need not sort of transmit the same kind of global shock that the taper tantrum did in the summer of 2013.
That's quite a solace. Thank you very much, Mr. Hathway, for joining us with your thoughts on the global markets and on what investors like you expect from India and the Indian budget. We have to take a break on that note, but coming up on the other side, a conversation with Evan Cameron-Watt, Managing Director and Chief Investment Strategist at the Investment Institute at BlackRock. He's also Portfolio Manager at BlackRock Inc. That chat in a minute.
Aditya Birla Group presents Budget 2015, the Make in India Budget, co-presented by SBI. What the world wants.